Hey, Strategic Financial Group, my name is Connor Mackey, and today I want to present you with the idea that the markets are pretty similar to weight loss. So if you had a goal to lose 10 pounds over a month and a half, you might say, I'm going to change my diet and I'm going to exercise more, right? But you have to be able to track that goal too. You have to be able to say, am I reaching that goal over a period of time? So you might start to weigh yourself. Most people would recommend you weigh yourself at the same time of every single week. Say it's Monday in the morning, right? But some of us, we really like numbers, and so we'll start to weigh ourselves every single day, maybe at the same time, but it's going to be every single day. And if you are that person, what you'll notice is that your weight, while it's going down, will also go up. And then it might go down again, then it will go up, and it'll go back and forth, right? With the whole goal, right, is that there's a trend that goes downwards. Markets are really similar. We look at a long period of time and we hope that the trend is upwards. But if we're looking at every day, we'll notice that they go up, they go down, they go left, they go sideways, they go every which direction they decide to go. Here's a picture that shows this, right? This is the S&P 500 dating back all the way to December of 1996. And you'll notice, well, first you'll notice that if you bought it at the beginning of December of 1996, you would have made almost 700% since then. But you'll notice that it goes up. There's some small dips. It goes down, it goes up, it goes down, but then it mostly trends upwards with some dips here and there. That's what markets do. They go up, they go down. This picture is exaggerated if we look at the year to date, right? If we look at the year to date, we see that it kind of went down a little bit, then up, and then up and down, and then down, and then really hit a floor right here on April 8th. Then we see it start to go up as pauses on tariffs start to come through. The question is why, right? And even if we look at the 5-day, we see even more. And even if we look at the 1-day, right, we see it even more. When I first started recording this video, the markets were up. That's how long I've been recording this. And then you can see they actually were down at one point during the day. This represents a down right here, this very beginning of the day. And so markets even today have gone back and forth. The question is why? Why do markets seem to be doing this back and forth so much and with so much volatility recently? Well, there's this thing called the fear gauge, right? It's an index that tracks consumer sentiment on the markets. So this fear gauge, we usually want to see it anywhere between like 15 to 21. A little bit lower than that's fine too. In fact, lower is better. But every once in a while it starts to peak. And this is what we're seeing. So this is year to date. This is the fear gauge, right? Higher is worse. You can see at the beginning of the year, we were, this says 16, approaching 20, 15, approaching 20 again, anywhere between 15 and 20. Now, right here, there's some talks of tariffs starting to happen, right? And so there's a raise in the fear gauge. What is this going to do to the economy? But then it starts to settle down again. And then what happened here? Oh, April 2nd, that's Liberation Day. And so the next day, things start to peak. And then some pauses went on tariffs and things start to decline a little bit. And we see the fear gauge going back and forth, similar to how markets do as well. But that doesn't mean we're out of the woods yet. In fact, the fear gauge really just tells us how people are feeling about the markets. And yes, it's based on numbers. It's based on actual trading volume and market volatility, but it is really about consumer sentiment. How are people feeling? And right now, the fear gauge for today is up a little bit. And why is that? Well, if we look at something you may have seen in the news, Moody's, which is a nonpartisan, which is a third-party rating system in the economy, said that they're lowering the credit rating of the United States from AAA to AA1. Well, what does that even mean? It means that they believe that the U.S. economy or the U.S. is more likely to default on their loans. That's not to say that we will. We have not done that, but it's a concern, right? And markets are reacting to that just a little bit. But this is also nothing new. S&P, Standard & Poor, they did this too at one point. They lowered the credit rating of the United States from AAA to AA+, which is the same thing as AA1 from Moody's. But what you'll notice about this is that this happened in 2011. This is an old credit drop that is kind of being forgotten right now in the news. They're not really talking about this. This isn't the first time the United States has gone through this. It won't be the last, probably. Credit ratings go up, they go down, they do the same thing that the markets do. It's not something we're concerned about. The markets, if this was something that was really to be concerned about, you'd see more of it in the markets. You'd see a steep decline, when in reality, markets are doing what they've been doing all year, which is bouncing back and forth, and hopefully, like weight loss goals, trending in the right direction, which is up.